Jobs data is coming out right now. We are waiting for jobs data, expecting 230, and we got 209. It comes in soft. Oh, wow. Okay, well, the market's going to like that. I was hoping it'd be stronger, but okay. Change in private payrolls comes in at 149 instead of 200,000. That's also soft. The average hourly earnings, oh no, that's not good, comes in at 0.4 versus 0.3. That's not great. Average hourly earnings year over year comes in at 4.4 versus 4.2. The labor force participation rate is 62.6. The unemployment rate stays, or actually does come in at 3.6 as expected. I don't love that. See, that's actually the opposite of what I would have preferred to have seen. I would have preferred a stronger jobs report with lower average hourly earnings gains. But no, we actually got a tick up in average hourly earnings and a weaker report. So, the stock market's actually going up on this, which is just like stupid. But, okay. Then we actually got a downward revision last time. Oh, interesting. And we got a downward, negative revision here on wage gains for last time. So, not great. We got a 0.3 was the prior average hourly earnings wage growth level that we had. That went to 0.4. Okay, well, at least we didn't go up. We basically are stable at 0.4, which roughly aligns with what you see in the ADP report. But this is a lot weaker than the ADP report. For the prior payrolls report of 339, that got adjusted down to 306. So got a downward revision here as well. And then you got the average hourly earnings year over year that got revised up to 4.4 versus the 4.3 that we had. So in English, what just happened here? Well, you actually got a weaker jobs report. The private ADP report came in strong, but they measure things differently than the official Bureau of Labor Statistics. Generally, the BLS report is the one that everybody really cares about and the Fed really cares about, though the ADP report can be a little bit of a fact-check tool for us. What I really like looking at in the ADP report is the hourly earnings. We like to see, hey, what's going on with average hourly earnings? And yesterday's ADP report was actually pretty great. Job stayers had pay gains of about 6.4%. Job changers at about 11.2%. These are year-over-year numbers. But those numbers were all falling, right? Consistently falling. We did get the unfortunate news that in this BLS report, you are stable at about 0.4 on wage gains. We'd like to see that come down. 0.4 is unfortunately consistent with 4.8% inflation on a yearly basis. That is not great because 4.8% on a yearly basis is well above the 3% target that the Fed has for wage growth. Note, that is not 2%. I didn't misspeak. It is 3% is the Fed's wage growth target. But we're sitting at about 4.8 right now. So it is less than what it has been in the past, but it's just not. We prefer 3, right, or 3.6. Anyway, so non-farm payroll increased 209,000. A lot of estimates here coming out that you're going to see negative payroll prints soon, and that is recessionary. Negative numbers are recessionary, so you want this to be positive. All right. This news release presents statistics from 2 monthly surveys, the household survey and the labor force participation survey via the establishment survey. Household survey data. All right, let's see. 6 million unchanged here, 3.6%. Unemployment rate has ranged 3.4 to 3.7% since March of 2022. White unemployment declined to 3.1%. Adult men 3.4, women 3.1, teenagers 11, black 6%. Asian, 3.2, Hispanic, 4.3, little changed. Long-term unemployed, little changed. Labor force participation, 62.6, fourth consecutive month in a row. Part-time employment for economic reasons increased by 452, reflecting an increase in the number of persons. Oh, look at this. Whose hours were cut due to slack or business conditions. So you're getting more people working part-time right now because their hours are getting cut. Now, this is a new line right here. I don't believe we've seen this in the prior labor reports. For economic reasons, individuals who would have preferred full-time employment but were working part-time because their hours had been reduced or were unable to find full-time jobs. Folks, keep in mind, this is the first miss that we've gotten since April of 2022. First miss since April 2022. That's, what is that, 13, 14, 15 months? All right, let's keep going here. All right. The number of persons not in the labor force who currently want a job was 5.4 million in June, little changed from the prior month. These individuals were not counted as employed, or unemployed rather, because they're not actively looking for a job. Fine. Get off the chair and go look for a job. Well, that'd be Ben Mala for you. Anyway, among those not in the labor force who wanted a job, the number of persons marginally attached to the labor force was little changed. At let's see here. That's fine. 1.4 million. These individuals wanted and were available for work. Fine. The establishment survey was the 209,000. Okay, let's see here. Non-farm employment was an average of 278 per month over the first 6 months of 2023, lower than the 399 average per month of 2022. Now, that's important. So, last year, we're trending at basically 400,000 jobs. This year, we're trending at 278,000 jobs. However, now we're down to 209. So, Wall Street here is saying this is not the best picture for the Fed. Unemployment rate falling with participation rate holding steady and wages up a bit, signaling somewhat that you still need tightening, but this is some of the commentary here, but you've got that average wage gain at 0.4%, which again is like, hey, it's still not fully biting the Fed's work here. Average work week lengthened a bit to 34.4 hours. It's interesting. To some extent, what you're finding is if hours are going up, but more people are working part-time, are you putting more work on the people that you're kind of keeping around, right? That is interesting. So, okay, let's see here. First, yeah, okay, we got that. That's okay, I'm just looking at commentary here as well. Keep in mind that after the blowout surge in private sector payroll suggested by the ADP report, this payrolls figure is quite a lot softer than the market would have expected. Yeah, no kidding. It's so bizarre that the stock market's actually going up on this. Whatever. Anyway, employment in the government increased by 60,000 in June. Fine. Healthcare added 41,000. We've got social assistance adding 24,000. Construction 23,000. You've got 15K on average in construction. You're up above that at 23,000. In June, employment in residential trade contractors continued up. So construction continues to go. Home builders are really pushing numbers right now. It's pretty remarkable. Let's see what Nick T is saying as well. While I pull up what Nick T is saying, I have a feeling what he's going to say is that you should check out the coupon on Building Your Wealth link down below. And the fact that you can now shadow us again when we go hunt for real estate. Link down below. If we travel, you travel with us. If we're local, you're local with us. So check that out. Okay, so Nick T quickly, just to see his commentary. The U.S. economy added 209,000 jobs in June. A revision subtracted 110,000. The unemployment rate ticked down to 3.6 from 3.7. This gives you, here are some of his charts. Private sector payroll growth, 3-month average. Here's your 3-month average plummeting, which isn't great because remember, labor is a lagging indicator. So these, when this starts going down, you really start knocking on the door of recessionary concerns. Not fantastic. I don't love it when that number goes down. So I actually would have preferred a stronger report here, but well, can't always get what you want, man. Employment in leisure hospitality was little changed according to this employment report. That I just also find somewhat hard to believe, but okay. This marks the third consecutive month of little employment change for leisure and hospitality. In other words, people who are going to be employed by leisure and hospitality are already employed, which is very different from that ADP survey. But okay, shows you the volatility of the data. Employment in professional and business services, little change, 21K. Retail trade, negative 11K over here at retail trade. Employment continued to decline at building material and garden center and supply dealers, as well as in furniture. Motor vehicle parts added 6K jobs, transportation down 7K, little changed. Little change in oil, gas, manufacturing, IT, finance activities, quarrying, and others. Here's your average hourly earnings, 33.58. That is a bump again of 0.4%. On a month-over-month basis, you've got the prior revision, which we've already reviewed. Now let's go ahead and get the actual households data as well. So they always make this a little funny to get, but we can get this. Household data. There we go. Labor force change from May to June. 133,000, if I'm reading this right. Hold on, let me put this in. I always have, just in full transparency, there's so many charts they give you here. I always have trouble reading this. So I'm going to just take a breath here, and we're going to look at this one slowly together. But it's important, because remember, you have two surveys. You have the establishment survey, which is your, hey, employers, how many employees you got? And then they count how many people they have on payroll. And then you have the household survey, which is like, the BLS calling households, saying, yo, you got a job? And they're like, yo, yeah, I got a job. Well, the problem with that difference is the payrolls one could count that same person multiple times. So it tends to be a little higher. Right here in the household survey. Okay, what do we have here? Well, okay. Yeah, see, I always have to be careful with this. The civilian labor force increased to 133,000, but the employed portion of that labor force increased 273,000. So you did have gains in both of them, both above 200,000, but the payrolls was actually 209, which is interesting because usually payroll's higher. So payrolls was 209, households was 273. Well, I guess it just depends on who you're calling. And that's why, this is why you generally like to use averages when you're looking at these particular charts, which you can jump on over, as we've seen, to the Wall Street Journal, via Nick T, or they also give us tables here. But this gives you an example on screen now, what it looks like when you get a little bit more of a charted trend. And then, of course, you can churn this out as a 3-month average as well, which just helps us get a little bit of a better understanding since the numbers are a bit volatile. So if I go for, let's see here, and I want to grab a little bit more information here. Okay, there we go. Okay, so looking at the rest of this report, job leavers. See, this is actually a good thing right here. You generally don't want to see job leavers jumping much. 29,000 is acceptable, so that's great. Because job leavers implies that people are voluntarily leaving, and they're leaving because they think they can get a better job. But if you're part-time for economic reasons, increasing 452,000, that's quite a big bump. Could only find part-time work, 124. Slack or slow business work, 308,000. These numbers trending up. Let's see how we've been. June 2022, and we have April, May, June. Okay, so last year is here, and then April, May, June. So you can see some volatility in the numbers over here. It kind of looks like we've gone down to up for these numbers here. Compared to last year, we're definitely above these, though. So only able to find part-time work because of slow business, that's starting to really increase right here. I'd be paying attention to this quite a bit. That's a good one to pay attention to. Okay, let's see what else the suits are saying. And then we'll take a look at market's reaction as well as rates. So some commentary here that this report probably won't mean much for the Fed, that it would really take an employment report below 100,000 to get the Fed to consider actually pausing. But what it probably is going to do is it's probably going to start reducing the odds of a second hike. This might kill the second hike odds. We're probably still going to get that July one. even though I disagree with that idea of this sort of pause start nonsense. It's probably what's going to happen. Let's see here. Okay, we saw that participation rate was unchanged. Pickup in manufacturing employment. Really? I didn't see that. Maybe because of all the spending on EVs and battery plants is the suggestion here. I'm not convinced by that. Let me see here. Manufacturing I thought was stable. Manufacturing. Yeah, I don't know where they're reading that. It says here little changed for manufacturing. So I don't know why. I mean, it must have been a small pickup if they're noticing a pickup somewhere. Okay, and again, remember, this is a lagging indicator. You also have service. Oh, that's interesting. Temporary help service payroll. So temporary help with your business actually ticked down again. Also another leading indicator. Okay, let's see. Okay, let's look at treasury yields just to get a little bit more market reaction. Note that a bounce back in the household survey. Gauge rose by 273,000 in June. In May, there was a 310,000 job plunge. That was a big contradiction. It's so volatile on a month-over-month basis, the data. Okay, so now all of a sudden the market is green, though. You're up 39 bips on the NASDAQ, 12 bips on the S&P. Dow's up 4. Enphase up 0.07. Tesla's up, what, 0.28 over here. Interesting. And then what we have is we look at bonds. We're actually still seeing the 10-year with strength at up 1.9 basis points, sitting at 4.06. If we look at the 5-year break even, it's ticked down a teeny little bit to 2.22. The terminal rate is still sitting at 5.41, so still a little bit of pricing in the second rate hike. Anything above 5.375 would be pricing in a little bit. Then you've got 91.8 is still your expectation, 91.8% for the next hike. And it's still sitting at 27% for September, excuse me. So, okay. That is pretty good. Let me quickly see what other kind of commentary it looks like we're getting. Let's see here. No other really good commentary other than this was the lowest and first miss on a jobs report since April of last year. Pretty remarkable. And again, the market positive about this. Let me just reiterate why I'm not so positive about this. The concern, obviously, is if wages are going up by the tune of about 0.4%, that's your overall wage set, and you continue with strong, let's assume we continue with strong hiring in leisure hosp, you're probably going to be in a place where spending in leisure and hospitality is going to blow up. And so there is this risk over the next 3 months. And it's a short-term risk. It's not going to be a long-term risk, I don't believe. But I think there's a 3-month risk that you end up with elevated wage gains, low employment reports, sticky or even slightly rising core thanks to travel inflation, right? And then a Fed that somewhat starts getting nervous that core inflation is rising and low employment sticks around, which is somewhat, I hate to say it, stagflationary. This is what you don't want. I do think you have this short-term 3-month risk thanks to really summer travel here and summer spending. So I do think that creates some potential short-term headwinds for stocks, even if it's just the fear that this could happen. It's not good because it's going to lead the Fed to talk even dirtier to us. It's not just a matter of the hike of 1 or 2 hikes. It's the dirty talk.
Now, I want you to know this. When it comes to AI,
time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced